Reading 34, GIPS. Source, CFA 2018 book. The global investment performance standards meet the need for globally accepted standards for investment management firms in calculating and presenting their results to clients and potential clients. This reading has made the following points. The GIPS standards are ethical standards that promote fair representation and full disclosure of an investment firm's performance history. The GIPS were created and funded by the CFA Institute, formerly known as AIMER, with the participation of many experts and local sponsorship from numerous industry groups. The GIPS Executive Committee is the government's body responsible for developing and interpreting the GIPS standards. The GIPS standards include provisions for fundamentals of compliance, input data, calculation methodology, composite construction, disclosure, presentation and reporting, real estate, private equity, wrap fee, separately managed account fee, along with valuation principles, advertising guidelines, and verification requirements. Only investment management firms can claim compliance with GIPS. The GIPS standards must be applied on a firm-wide basis, and a firm may claim compliance with GIPS only when it has satisfied all the requirements of the GIPS standards. Accrual accounting must be used for all assets that accrue interest income and for periods beginning on or after 1st of January 2005. Trade date accounting must be used. For all periods beginning on or after 2005, trade date accounting must be used. For periods beginning on or after Jan 2011, all portfolios must be valued in accordance with the definition of fair value and the GIPS valuation principles. Firms must calculate total returns that include returns from cash and cash equivalents and are reduced by actual trading expenses. For periods beginning on or after Jan 2005, if a firm uses approximated rates of return, it must adjust them for daily weighted external cash flows. For periods beginning on or after January 2010, firms must value portfolios on the date of all large external cash flows. The large external cash flows can substantially distort the accuracy of the estimated returns when markets are volatile. The GIPS standards require firms to document composite-specific policies for the treatment of external cash flows and to adhere to those policies consistently. Composites must be defined according to their investment mandate, objective, or strategy. All actual fee-paying discretionary accounts must be included in at least one composite. Portfolios are discretionary if client-imposed restrictions do not prevent the firm from implementing the intended investment strategy. Composite returns must be calculated by asset weighting the individual portfolio returns using beginning of period values or a method that reflects both beginning of period values and external cash flows. Firms must include new portfolios in composites on a timely and consistent basis. Terminated portfolios must be included in the historical performance of the appropriate composite up to the last full measurement period they were under management. A firm cannot switch portfolios from one composite to another unless documented changes to a portfolio's investment mandate, objective strategy, or redefinition of a composite makes it appropriate. For periods on or after January 2010, the returns of a single asset class, like equities, carved out of multiple asset strategies, like a balanced account, invested in equity and fixed income securities, are not permitted to be included to be a single asset class composite unless carved out segment is actually managed separately with its own cash balance. The GIPS standards include detailed disclosure requirements related to the firm, performance calculation, benchmark, fees, composites, composite performance presentation, and other items. Additional disclosures are also recommended. The GIPS provisions for presentation and reporting require that at least 5 years of compliant performance must initially be shown, or from inception if it's been shorter than 5 years. The compliant performance record must then be extended each year until at least 10 years of results are presented. The GIPS standards specify required items to be contained in composite performance presentations, including composite and benchmark total returns for each annual period presented, the number of portfolios in the composite, if there's more than 5, at the annual period end, the amount of assets in the composite at annual period end, and either the percentage of the firm's total asset represented by the composite or the amount of total firm assets at the end of each annual period. A measure of dispersion of individual portfolio returns within the composite, and for periods ending on or after Jan 2011, the 3-year annualized ex post standard deviation of composite and bench returns. Other items may be required in certain cases, and additional items are recommended. Acceptable measures of internal dispersion include, but are not limited to, high and low, the range, and standard deviation. Performance of a past firm or affiliation must be linked to or used to represent the historical performance of a new or acquiring firm if all the following conditions are met on a composite specific basis. Substantially all the decision makers are employed by the new firm. The decision-making process remains substantially intact and independent within the new or acquiring firm. And the new or acquiring firm has records that document and support the performance. If a firm uses a custom benchmark or a combination of multiple benchmarks, it must disclose the benchmark components, weights, and rebalancing process. The frequency of rebalancing can affect the reported benchmark return. For periods beginning on or after January 2008, real estate investments must be valued at least quarterly. For periods beginning on or after Jan 2011, real estate investments must be valued in accordance with the definition of fair value and the GIPS valuation principles. Real estate investments must be valued by an external professionally designated, certified, or licensed commercial property appraiser at least every 36 months for periods prior to Jan 2012, and unless clients, this is a long one. For periods beginning on or after January 2011, real estate investments must be valued in accordance with the definition of fair value and the GIPS valuation principles. Real estate investments must be valued by an external, professionally designated, certified, or licensed commercial property appraiser at least once every 36 months for periods prior to Jan 2012, unless client agreements stipulate otherwise, at least every 12 months thereafter, January 2012. In addition to total return for real estate, firms must calculate the time-weighted return of income and capital return components. For closed-end real estate fund composites, the GIPS standards also require firms to present the net of fees since inception internal rate of return, the SI-IRR of the composite through each annual period end. For periods ending on or after Jan 2011, private equity investments must be valued in accordance with the definition of fair value and the GIPS valuation principles, and the annualized SI-IRR must be calculated using daily cash flows. Performance presentations for private equity composites must include gross of fees and net of fees, SI-IRR, of the composite through the end of each annual period. For closed-end real estate and private equity composites, the composite's cumulative committed capital, since inception paid-in capital, and since inception distributions must be presented as of each annual period end. In addition, firms must be present as of each annual period and the investment multiple, which is the ratio of total value to since inception paid in capital, or TVPI. The realization multiple, which is the ratio of since inception distributions to since inception paid in capital, which is the DPI. Or the PIC multiple, the ratio of since inception paid in capital to cumulative committed capital. And the unrealized multiple, which is the ratio of residual value to since inception paid in capital. When firms present performance to prospective RAP fee SMA clients, they must present the performance net of the entire RAP fee. Verification is a process by which an independent verifier assesses whether the firm has complied with all composite construction requirements of the GIPS standards on a firm-wide basis, and the firm's policies and procedures are designed to calculate the present performance in compliance with GIPS standards. A single verification report is issued for the entire firm. Verification cannot be carried out for an individual composite. Firms that have been verified may choose to have further in-depth examination of a specific composite presentation. The GIPS advertising guidelines allow a firm to claim compliance with the GIPS standards in an advertisement, but without presenting the compliant presentation. All advertisements stating a claim of compliance following the GIPS guidelines must use the prescribed wording for the GIPS compliance statement of advertisers. Advertisements that state this claim of compliance and show performance results must also present in the advertisement additional required information taken or derived from a compliant performance presentation. Effective Jan 2011, after-tax performance reporting, if presented as part of a compliant presentation, will be considered supplemental information and subject to the requirements and recommendation of GIPS guidance statement and the use of supplemental information.